This is Jody Trana with Chapter 5, Part 2 of Principles of Accounting. At this point, you're probably pretty comfortable with the income statements that we've been preparing. Remember that the income statements have the profit equation in them. That's revenue minus expenses equals net income. Now that we've started merchandise accounting, we're going to expand our income statement from this single-step income statement into a multi-step income statement. It's called the multi-step income statement because rather than just having revenue and expenses to come up with the net income, we have separate steps that we follow to identify different categories of expenses and different categories of profits, such as gross profit. Let's take a closer look at the multi-step income statement. This income statement also has the three-line title with the company name, the name of the report, and the period for which this report has been written. Remember that the income statement is for a period, so we identify what period it is. Here we have a whole year. The first section of the income statement is very important. Here we're identifying the gross profit that we have. That's in general our sales minus our cost of sales to identify how much money we have to operate the business. You'll also notice that we now have a net sales revenue number. Because we have two contra revenue accounts, those revenue accounts show up here as a reduction to sales revenue. Sales revenue minus sales returns and allowances minus sales discounts equals our net sales revenue. It's important for information and analysis to keep these three accounts separate. We never want to just automatically reduce our sales revenue because then we don't know what our true level of sales was for the year. And we also need to keep track of our sales returns and our discounts so that we can make decisions about whether our products are maybe defective. Maybe we have too many sales returns. Maybe we're giving too many discounts and that's hurting our profitability. So we really want to have these accounts separate. After net sales revenue, we have the cost of goods sold. This is a really important number as it's reporting the merchandise and how much it costs us to sell it. Right after gross profit, we start listing our expenses. You'll notice that we have the title of operating expenses. Operating expenses are the costs associated with operating or running our business. We've also identified these operating expenses and categorized them into two categories. One is selling expenses and the other is administrative expenses. The selling expenses are all the costs associated with marketing, advertising, sales department, everything related to actually selling our products. Administrative expenses are everything else. Those things are the costs of just running our business. The reason that we separate these two types of expenses is because the selling expenses should directly be related to sales. That is, here we're spending $21,600 in selling expenses. Those selling expenses should be bringing in sales. So this is a number we want to have separate so that we can see how efficiently our expenses are working to bring in sales. The administrative expenses, they don't work so hard to bring in sales. They work harder just to support the operations of the business. So we do want to see a total here, but we're not going to compare it to our sales so much as just to watch these numbers as compared to a budget. After we have these two categories, we add them together to come up with our total operating expenses. We take that number and subtract it from our gross profit to get our operating income. This is the number that tells us how much money we have made just from operating our business. After our operating income, we're going to list any revenues or expenses that aren't related to our main source of business, but have come to us or are expenses for us. Here you see interest expense is listed. The reason that interest expense is shown here in other revenue and expenses rather than in administrative is because it helps to identify this as an expense that's above and beyond operating. If we did not take out a loan, we wouldn't have interest expenses. It's an additional expense of doing business, not really operating. So we have our interest expense listed separately from all the other expenses. You'll also notice that it's a negative number. That's because when we put revenue and expense together, we show the expense portion as a negative so that we can keep track which numbers will add to our overall net income and which ones will take away from it. And expenses will definitely take away from it. You'll see here that our net income, also called the bottom line, takes into consideration this total other revenue and expenses number. So we have operating income minus our expenses equals net income. We also try and use more than one column for this multi-step income statement. That helps to keep the major important numbers over in the far right-hand column. Here you'll notice these important numbers are net sales revenue minus cost of goods sold equals gross profit minus total operating expenses equals operating income minus other expenses equals net income. It's time to talk about closing the books for our merchandising company. Remember that closing the books is a way to look at our accounts at the end of a period and identify if there's adjustments that need to be made in order to more accurately reflect our revenue and our expenses, and to make sure that all of our general ledger accounts are accurate. Once we do this, then we're free to produce reports, financial statements, and do things like our taxes, because we will be assured that our balances are correct and our financial statements accurately reflect our company. In a merchandising company, one of the adjustments that needs to be made is to account for any changes that there might be in inventory based on a physical count. Very rarely will the physical count represent the exact amount that we have in our account in our books. Things get broken, inventory gets stolen, a lot of things happen, and sometimes we just make an error in reporting things that have arrived. It could be wrong either way, but it usually, our physical count will show less inventory than we have in the books. The journal entry would be a debit to cost of goods sold and a credit to merchandise inventory. Keep in mind that when we did our physical count, we identified that there was only $31,290 in merchandise inventory. So we were going to need to credit our merchandise inventory to reduce it from our $31,530 value. The difference is an expense that will show up as a reduction of our revenue on the income statement. Remember, the process of closing the books is to close revenue first into the income summary account, and then to close expenses also into the income summary account. Third, we close the income summary account into the capital account. And finally, we close the withdrawals into the capital account. You should be pretty comfortable with these closing journal entries, but there are a few changes highlighted in blue. When we close the revenue account, it's now called sales revenue. When we close expense accounts, we also have a couple of new expenses. But first, let's talk about the contra revenue accounts that are listed. These are revenue accounts, but we don't close them with the main sales revenue account. That's because their normal balances are credits. When we close out the expenses, we will also close out the two contra revenue accounts of sales returns and allowances and sales discounts. The two new expense accounts that are being closed are cost of goods sold and delivery expense. There are no new accounts related to closing the income summary and to closing the withdrawal account. So now you know everything there is to know about closing the books for a company.